Welcome to today's Daily Digest for August 13th, 2026. A clear split emerged across the technology sector after the bell today. Semiconductor manufacturing equipment leader Applied Materials delivered a record third-quarter revenue blowout of $9.12 billion, up 25% year-over-year. At the same time, enterprise networking giant Cisco Systems projected $7.5 billion in artificial intelligence revenue for fiscal 2027. This divergence highlights that while chip foundries are spending aggressively on hardware tools, enterprise networking deployment is moving at a measured, multi-year pace. Today, we unpack this hardware stack split, examine SanDisk's 80% margin floor targets, and analyze where institutional capital is deploying across market pullbacks. Starting with the main catalyst today, Applied Materials reported quarterly revenue of $9.1 billion, topping Wall Street expectations and setting a company record. Non-GAAP earnings per share reached $3.50, while operating income expanded to $3.1 billion. Gross margins widened to 50.4%, demonstrating strong pricing power for advanced materials engineering tools. The results confirm that global semiconductor foundries continue to pour capital into next-generation wafer fabrication equipment to support expanding artificial intelligence compute demand. Looking ahead, Applied Materials raised its semiconductor systems outlook for calendar year 2026 and signaled that fiscal 2027 will be another expansion year. Management noted that customer visibility for advanced packaging and gate-all-around transistor tools has improved significantly. While post-market stock trading showed initial choppiness near its 50-day moving average, the underlying order flow demonstrates that leading-edge chip makers are locking in tool deliveries years in advance to avoid production bottlenecks. In contrast to chip equipment manufacturing, Cisco Systems presented a more measured timeline for enterprise networking integration. Cisco reported fourth-quarter revenue of $17.3 billion, up 18% year-over-year, and secured $4 billion in artificial intelligence infrastructure orders during the quarter. For fiscal 2027, Cisco projected $7.5 billion in artificial intelligence revenue. While hyperscalers are ordering networking gear at a triple-digit pace, broader enterprise adoption is following a phased rollout schedule rather than an immediate spending surge. This comparison reveals an important structural shift across the technology stack. Equipment providers like Applied Materials sit at the foundation of silicon manufacturing, where lead times require early capital commitments. Networking providers like Cisco depend on enterprise data center construction and software integration, which convert into realized revenue over a longer timeline. Understanding this distinction prevents investors from misinterpreting adoption timing as a loss of end-market demand. Turning to memory infrastructure, SanDisk presented its long-term financial model at its 2026 Investor Day today. The company projected non-GAAP gross margins to remain near 80% through fiscal 2030, alongside operating margins of 75%. This outlook indicates that flash memory is transitioning away from traditional boom-and-bust commodity cycles towards structural, high-margin profitability driven by enterprise data center expansion. A key driver of this margin stability is SanDisk's shift toward multi-year customer agreements. By fiscal 2028, SanDisk expects two-thirds of its total flash production capacity to be secured under long-term supply contracts. These agreements lock in procurement volumes and pricing floors, protecting memory producers from short-term spot market fluctuations and offering clearer earnings visibility for long-term investors. Institutional portfolio filings released this week show major asset allocators capitalizing on recent tech volatility. Bill Ackman's Pershing disclosed new positions in S&P Global, Visa, Mastercard, Intercontinental Exchange, and Netflix. Rather than chasing speculative momentum, institutional capital is building positions in financial infrastructure platforms with durable pricing power and high free cash flow conversion. S&P Global provides a clear example of this valuation framework. Market concerns over artificial intelligence disrupting financial data tools contributed to a recent 25% pullback in the stock. However, a close look at the segment breakdown shows that the vulnerable Capital IQ division accounts for less than 7% of total company revenue. The core rating agency and index licensing businesses retain deep competitive moats, creating attractive entry points when broad market fears drag down high-quality platforms. Beyond large-cap technology, credit data highlights growing divergence in the real economy. U.S. small business bankruptcy filings have increased 50% year-over-year, according to court records. Higher borrowing costs and sticky input inflation are weighing on smaller enterprises that lack the balance sheet flexibility of mega-cap corporations. This Main Street debt pressure contrasts sharply with record S&P 500 earnings growth, underscoring the uneven nature of the current economic environment. On the global macro front, monetary policy paths continue to diverge. While Western central banks maintain a cautious stance on rate cuts, the People's Bank of China has initiated liquidity expansion measures to combat domestic debt deflation. This liquidity injection is designed to support internal credit growth and balance sheet stabilization across Asian industrial supply chains. This global liquidity dynamic is reshaping commodity and currency flows. Central bank purchases of physical gold continue to outpace paper asset allocations as institutional managers seek hedges against sovereign debt issuance and currency devaluation. Physical commodities and scarce real assets are gaining favor relative to speculative digital instruments as macro capital prioritizes tangible balance sheet protection. In summary, today's market action highlights three core themes. First, Applied Materials' record quarter demonstrates ongoing foundry CapEx strength, even as networking adoption follows a multi-year pace. Second, SanDisk's contract framework confirms structural margin floors in memory hardware. And third, institutional smart money is using tech volatility to acquire high-moat financial infrastructure at discounted valuations. Maintaining focus on cash flow durability and balance sheet strength remains key as market rotation continues. Thank you for tuning in, and we will see you tomorrow.